The fight on inflation isn't over yet. At least that's according to Jamie Dimon, who is the CEO of JP Morgan Chase Bank, who just did an interview with Reuters. And what he said was, quote, inflation might not come down the way that people think. Essentially what he's saying is that before you claim this victory on inflation, because we've been seeing inflation come down for the last few months, it is not over yet. During the interview, what he was saying is, yeah, we've seen inflation come down off of its highs, but getting it from where we are now down to the 2% target, which is what the Federal Reserve Bank says that they want to do, is going to be more difficult than what most people think, and that's going to require more pain to the economy. He went on to say that, quote, I just think people should take a deep breath on this one before they declare victory because 1 month's number looks good. Essentially what he's saying is that before we get too excited about the economy being okay, we're going to be able to have the soft landing and everything's going to be just fine, understanding that this last bit of inflation, to get it all the way down to 2%, is going to require more work, meaning higher interest rates by the Federal Reserve Bank, and that's going to have its own consequences. What he said is, I think that the Federal Reserve Bank will go to 5% interest rates and then stay there for a while and then see what happens. And then he went on to say that if inflation comes down to about 3.5%, but we can't get it down from the 3.5% level down to the 2% level, then the Federal Reserve Bank might be forced to go higher than the 5% in interest rates that we have right now. Now, to put that in perspective and explain what that means, the Federal Reserve Bank sets interest rates. The interest rates that they set are called the federal funds rates. These are not mortgage rates. These are not the interest rates you pay on a car. The federal funds rates are the interest rates that banks pay when they lend money to one another. So you can kind of think of it like the wholesale rate that banks get to borrow money at. Now, when banks borrow money at the wholesale rate, they then mark it up and then sell it to you at the retail rate. That's why when you go out and borrow money, it's going to cost you more money. Just like when you go to the store at Amazon to go buy something, Amazon might buy it at the wholesale price from the manufacturer and then sell it to you at the retail price, which is the marked up price. This is where what Jamie Dimon is saying is that we could see inflation come down even more. But to get it down from the 3.5% level down to the 2% level, which is where the Federal Reserve Bank wants, that's going to require more work, and then that could cause more pain in our economic system because when you keep raising interest rates, well, the higher interest rates make borrowing money more expensive. That slows down the economy, that causes more layoffs, and that's what he's saying that we have to be ready for, and that most people don't see that coming, and most people are not predicting that because now what you're seeing a lot of people do is they're betting that, one, the Federal Reserve Bank is maybe going to raise interest rates one more time and then be done. And two, that the Federal Reserve Bank might even start pivoting, meaning start cutting interest rates. Why would they do that? Well, if we see a slowdown in the economy, if we see more layoffs, then the Federal Reserve Bank might want to stimulate the economy, which would hurt inflation, but stimulate the economy by cutting interest rates, which makes borrowing money cheaper, which then stimulates the economy because now people have more money to spend, but that comes at the price of then increasing inflation. Now, as of today, Jerome Powell, who's the chairman of the Federal Reserve Bank, is saying that he has no plans to pivot. He has no plans to cut interest rates. And in fact, he wants to keep inflation down. So he wants to keep raising interest rates until inflation comes down. And a lot of people are betting that the Fed is not going to continue raising interest rates maybe after the next meeting. But this is where we're going to be paying attention to what happens with inflation and the jobs numbers. Now, the interesting thing with inflation is looking at kind of where are the prices of things rising. Now, we've been covering this in Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. It's a completely free newsletter that I created where my team is working every day to break down what's happening in things like inflation and the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read email. That way you can stay up to date on what's happening. That way you can make smarter decisions with your money. So if you want to join Market Briefs, it's completely free. And I'll put the link to how you can join down in the description below. But now if we look at the things that are affecting inflation, there's two different inflation numbers that the Federal Reserve Bank looks at. They look at the headline inflation number called your CPI, and then they also look at the core inflation. The Federal Reserve Bank actually prefers looking at core inflation. Core inflation is when you look at the inflation number and then you take out what they call the volatile numbers, which are energy and food, because who needs energy and food? But they look at those numbers. And what we've been seeing is over the last month, We have started to see gas prices start to rise again. There was just a report that Russia announced that they are going to decrease their production of oil, which would also affect gas prices and oil prices. How much? Well, I guess time will tell. But in general, we've been seeing gas prices rise. That plays an effect on inflation. And in addition to that, because we've kind of seen mortgage rates go a little bit lower in January and even towards the end of December, well, that has also contributed to a kind of unexpected little boom in the housing market, which would also contribute to higher inflation. So it's going to be interesting to see in February and March, when we get the January and February inflation numbers, where inflation actually is going, because our inflation data and most of our data in general are lagging indicators. We don't get the information when it's happening. We get the information 30 days after it happened, and then people make decisions after we find the data after the fact. So it's going to be interesting to see where inflation is going. And it's going to be also interesting to see where the job market is going, because in January, we got a very strong jobs number, which scared a lot of investors, because a strong jobs number can also contribute to higher inflation, which would contribute to higher interest rates. You can kind of see why we're in such a weird stage of our economy, because normally a strong jobs number means our economy is booming and the markets would rise. Now you're seeing a strong jobs number, people get freaked out, and the stock market falls down because they see the strong jobs number and they think that means higher interest rates, which mean more pain to the economy. So kind of a strange situation that we're in right now. But we saw the strong jobs number, which could indicate that we have more inflation coming. But in addition to that, it's where are CEOs really putting their focus? Because we're starting to see a much bigger diversion. Like towards the end of 2022, this started to happen, but now it's like getting wider and wider and wider, where you have the CEOs saying there's a recession coming, we're preparing, and we see the effects of it already starting. And then you have the other CEOs saying, we see no signs of a recession, we see no signs of an economic slowdown. Like the American Express CEO keeps saying that we haven't seen any signs of an economic slowdown. If you look obviously at the tech sector has been really struggling. That's partially due to the slowdown in the economy, partially due to a slowdown in advertising, because many of these tech companies rely on advertising dollars, businesses spending money on advertising, and they've been seeing the advertising money drop, while they're also not able to raise as much money as they could before, because now investors want a higher return, because when you have to borrow money at a higher rate, you have to justify these higher interest rates with higher returns for investors. So you have some companies now that are starting to say, yeah, we are starting to see a slowdown, and this is where, over the next few months, we're going to see this diversion probably get even bigger, and then that's where kind of we will see where our economy is really heading. Now, I believe that we're going to see more pain in our economy. That's my personal opinion. I try to avoid talking about my opinions. I try to kind of focus on the facts here. But I believe that we have more economic pain ahead. But in any case, what this means for you is not to blindly follow a random guy on YouTube or really blindly follow anybody, but just to understand, okay, what are the options? Option A is we see pain in the economy. Option B is the economy continues to boom. What should you do? Well, the thing that you want to do is prepare for the worst and be ready for the best. The way you do that is by 1, having cash to protect yourself from an emergency. 2, having cash to capitalize on investment opportunities, because if we do continue to see more pain in the economy, that means investment prices, asset prices could go on sale. And if they go on sale, that creates opportunity for you. So being prepared for that, but then also having an investment strategy. Like I have what I call an active strategy and a passive strategy. A passive strategy, and we'll focus just on the stock market to keep it simple. A passive strategy in the stock market is every Wednesday, doesn't matter what day you pick, but for me it's Wednesday. Every Wednesday, I have cash that leaves my checkings account and is automatically invested into the stock market. I have a portfolio of ETFs, and every Wednesday, cash is automatically pulled out of my checking account and is invested. This does not matter if the market is up, does not matter if the market is down. I am constantly, always doing this, and it's passive, it's automatic, and it's consistent. So no matter what's happening, I have this investment happening. So if the market's going up, great, my portfolio is rising. If the market's going down, great, I'm buying more assets with it. Then I have my active strategy, which is now I have cash. And right now I'm sitting on more cash than really ever before. I have this cash pile that is waiting to be deployed. Now, when will this cash be deployed? When I find a good opportunity. Maybe it's in stocks, maybe it's in real estate, maybe it's in something else, but I have this cash pile that's sitting here that's waiting to find a good investment. Maybe I wait 12 months, maybe I wait 24 months, maybe I wait 2 months. I don't know. When I find a good enough deal, then I will go out and start investing more of this cash. Now, this doesn't mean that I won't invest anything, but if I find a good enough deal, then I will go out and invest. And I think that we're going to see more opportunities in the next 12 to 24 months. And so I'm preparing myself. Now, let's assume now that nothing bad happens. The economy continues to boom and we completely avoid any sort of economic pain and everything continues to grow. Well, I just got a big bank account and I can use the money to go out and buy more assets, or I can use this money to go to Disneyland. So it's really your choice. It costs you nothing to be prepared, but it costs you everything if you're not prepared.